Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today, we are breaking down one of the most important investment decisions everyday people face right now: stocks versus bonds versus certificates of deposit. In today's market environment, this comparison matters more than ever. Interest rates are still elevated. The stock market is at record highs, and a lot of people are asking the same question: where should my money actually be right now? We are going to answer that question today with real numbers and a clear framework for making the right decision based on your specific situation. Quick note before we get into it: everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Everyone's financial situation is different, so always do your own research or speak with a qualified financial professional before making investment decisions. Let's get into it. Let's start by clearly defining each of the three options so everyone is working from the same foundation. A stock is a share of ownership in a company. When you buy a stock, you own a small piece of that business. If the company grows and becomes more valuable, your investment grows with it. If the company struggles, your investment can lose value. Stocks offer the highest potential return of the three options, but also the highest risk and the most volatility. A bond is essentially a loan you make to a government or corporation. They borrow your money for a set period and pay you interest in return. At the end of the term, they return your principal. Bonds are generally more stable than stocks, but offer lower returns. The US government issues treasury bonds. Companies issue corporate bonds. Cities and states issue municipal bonds. A certificate of deposit, commonly called a CD, is a savings product offered by banks and credit unions. You deposit money for a fixed term, anywhere from a few months to several years, and the bank pays you a guaranteed fixed interest rate. At the end of the term, you get your money back plus interest. CDs are FDIC insured up to $250,000, meaning your money is protected even if the bank fails. They offer the lowest return of the three, but also the lowest risk. Now let's look at where each one stands in today's specific market environment. Where stocks stand right now. The stock market is at record highs as of April 2026. The S&P 500 is trading around 7,170, a level that would have seemed extraordinary just a few years ago. The Nasdaq is also near all-time highs. The driving force behind these record levels is artificial intelligence. Technology companies are delivering earnings growth of roughly 46% this quarter. The biggest names in tech, Microsoft, Amazon, Alphabet, Meta, and Apple, are spending hundreds of billions of dollars building AI infrastructure, and the market is rewarding them for it. What does that mean for you as an investor? If you are invested in a broad S&P 500 index fund, you have participated in this rally. Your investment has grown. That is the good news. The question now is what comes next. At current valuations, stocks are priced for continued strong growth. If the big tech companies deliver strong earnings this week, and they are expected to, the market likely continues higher. If they disappoint, or if the Iran situation escalates and drives inflation higher, that record high market could pull back. The historical average annual return of the S&P 500 is approximately 10% per year over the long term. That includes every bull market and every crash. For long-term investors, meaning people with a horizon of 10 years or more, stocks have historically been the strongest wealth-building vehicle available. But for money you need in the next 1 to 3 years, the volatility of stocks creates real risk. A 20 or 30% pullback when you need the money is a problem that bonds and CDs simply don't create. Where bonds stand right now. The bond market in 2026 is in an interesting position. Interest rates are still elevated by historical standards because of the Federal Reserve's battle against inflation over the past few years. That elevated rate environment actually makes bonds more attractive than they were when rates were near zero in the early part of this decade. The Bloomberg US Aggregate Bond Index delivered roughly 7% returns in 2025. That is a meaningful return for a low-risk asset. And with the Federal Reserve expected to potentially cut rates 2 to 3 times in 2026, there is an additional opportunity in bonds beyond just the interest payments. Here is why that matters. When interest rates fall, bond prices rise. So if you buy bonds today at current elevated rates, and rates come down over the next year or two, you benefit in two ways. You collect the interest payments and your bond increases in value. Charles Schwab's bond outlook for 2026 is positive, expecting solid returns driven by central bank rate cuts. They recommend focusing on high-quality bonds with intermediate-term maturities as a balanced strategy for the current environment. For investors who want lower risk than stocks, but better potential returns than a savings account, bonds are genuinely compelling in today's environment in a way they have not been for many years. Treasury inflation-protected securities, known as TIPS, are also worth knowing about. These are government bonds specifically designed to protect against inflation. Their value adjusts with the Consumer Price Index, so if inflation stays elevated, your TIPS investment keeps pace. Real yields on TIPS currently sit between 1.25 and 2% above inflation, meaning you are earning a guaranteed real return on top of inflation protection. Where CDs stand right now. Here is where CDs get interesting. The best CD rates available right now are paying around 4% annually. The top rate tracked by Bankrate as of April 2026 is 4.20% offered by Mountain America Credit Union. Multiple banks are offering rates in the 3.6 to 4.05% range for various terms. To put that in perspective, just 3 years ago, the best CD rates were paying less than 1%. The current rate environment has made CDs more attractive than they have been in over a decade. Here is the critical timing issue with CDs right now. CD rates are expected to decline in 2026 as the Federal Reserve potentially begins cutting interest rates. Once the Fed cuts rates, bank CD rates follow. That means the window to lock in rates around 4% may be closing. If you have money you know you will not need for 6 months to 2 years, an emergency fund beyond your immediate needs, savings for a specific goal, money you want protected from stock market volatility, locking in a 4% CD right now before rates decline could be a smart move. The key advantages of CDs in today's environment are clear. The return is guaranteed. The principal is protected. The FDIC insurance means your money is safe regardless of what happens in the stock market or the broader economy. And the rates are genuinely competitive in a way they have not been in years. The key disadvantage is that your money is locked up for the term. Early withdrawal typically means a penalty. And unlike stocks, there is no upside beyond the fixed rate. If the stock market delivers 15% this year, your 4% CD does not participate in that gain. Now, let's compare all three side by side in today's environment. Current potential returns. Stocks. Historically 10% annually over the long term, but with significant short-term volatility. Currently at record highs with strong momentum driven by AI earnings. Bonds. Approximately 4 to 7% depending on type and term, with potential for additional price appreciation if rates fall. CDs. Approximately 3.6 to 4.20% guaranteed, FDIC insured, no market risk. Risk level, stocks. Highest risk, highest potential reward. Can lose 20, 30, or 40% in a market downturn. Bonds, moderate risk. Government bonds are very safe. Corporate bonds carry some credit risk. Bond prices fluctuate inversely with interest rates. CDs, lowest risk. FDIC insured up to $250,000. Principal is guaranteed. The only risk is inflation eroding the purchasing power of your return over time. Liquidity, meaning how easily can you access your money. Stocks, highly liquid. You can sell stocks any trading day. Bonds, moderately liquid. You can sell bonds before maturity, but may receive more or less than you paid depending on current rates. CDs, least liquid. Early withdrawal typically incurs a penalty. Money is committed for the term. So, which one is right for you? The honest answer is that the right allocation depends entirely on your situation. But here is a practical framework. If your time horizon is 10 or more years, meaning you are investing for retirement or long-term wealth building, and you will not need the money for a decade or longer, stocks through a low-cost S&P 500 index fund or similar vehicle remain the strongest long-term wealth building tool available. The short-term volatility is real, but history consistently shows that long-term investors are rewarded. If your time horizon is 3 to 10 years, meaning you have medium-term goals like buying a home or funding education, a mix of stocks and bonds makes sense. You want some growth potential from stocks, but bonds provide stability and cushion against a market downturn at exactly the wrong time. If your time horizon is 1 to 3 years, meaning you need this money relatively soon and cannot afford to see it drop in value, CDs and short-term bonds are your best options right now. Locking in 4% guaranteed with FDIC protection for money you know you will need in 12 to 24 months is a genuinely smart move in the current rate environment, and you should do it soon before rates potentially decline. If your time horizon is under 1 year, meaning this is your emergency fund or money you need readily available, a high-yield savings account offering 4 to 5% with full liquidity is likely a better option than a CD, since you do not want early withdrawal penalties on money you might need unexpectedly. One final thought on diversification. The most important takeaway from today's breakdown is that stocks, bonds, and CDs are not competitors. They are tools that serve different purposes in a well-constructed financial plan. Most financial advisors recommend holding all three in proportions appropriate to your age, risk tolerance, and time horizon. Younger investors with long time horizons tend to hold more stocks. Investors approaching retirement tend to shift more toward bonds and stable income-producing assets. And everyone should maintain some highly liquid safe savings, whether in a CD, a high-yield savings account, or a money market fund, for emergency reserves and short-term goals. The question is not which one wins. The question is, how much of each do you need given where you are in life and what you are trying to accomplish? That is a wrap on today's breakdown here at Capitalists versus Consumers. If this gave you a clearer picture of where each of these options stands in today's market, please hit the like button. It helps more people find this content. And if you are not subscribed yet, hit subscribe and turn on notifications so you never miss a report. Every trading day after the close, we bring you after the bell. And every Friday, we do a full weekly market breakdown right here at Capitalists versus Consumers. We will see you in the next one. Resources mentioned in this video: The Little Book of Common Sense Investing by John Bogle, The Psychology of Money by Morgan Housel, I Will Teach You to Be Rich by Ramit Sethi. This video contains affiliate links. I may earn a small commission at no extra cost to you.